economies come back up. So they don't do it. I think it's also important for us to explain that the mandate of the Fed is not to control the markets. Like the Feds are not, the markets will affect the Feds, but that's not their job. Welcome to the Traders Show. This show is brought to you by Pepperstone. Pepperstone is an award-winning online global forex and CFD broker. It offers unparalleled service, exceptional pricing, and fast execution speed. Pepperstone gives you access into the global markets with more trading opportunities, first-class customer service, and peace of mind. Withdrawals are quick, and for those in Kenya, M-Pesa is enabled. Pepperstone Markets is regulated by the Capital Markets Authority. To open an account with Pepperstone, you can click the links on the descriptions below.
Companies.
Exactly.
The guys online. We switched a lot to online. So Nasdaq was quick recovery.
Tech companies really performed. Because I think tech companies actually car 140% up since the COVID low.
Most of them,
140.
Very high. If you look at a company like Tesla, it's very high.
Look at Tesla relative to and I think we'll just have a chunk to talk about Tesla in this
towards the end.
And where we think positioning and how we think markets will move forward, like depending on if threats come into the markets.
Okay, so Ken, now if you can explain to people, I think you're at a better position in terms of the bond purchasing, the yields. Well, what do you think about that?
So if you go back and read history, like you're saying, so all these things, if you want to understand them, I think in the financial markets, like we always say, it's a story repeating itself, only that it's wearing different clothes or in a different tone or by a different narrator. The story is always the same. Mm-hmm. So if you look at markets historically, if you go back 100 years, 200 years back, you'll understand that long time ago, they would use interest rates to control the movement up and down to bring growth and cut growth and go into recessions, control recessions.
So they're playing with the levels.
Exactly. But as we went into the 90s, 2000s, it was very, very clear interest rates are no longer working. So pushing interest rates up and down was no longer that effective. So we came up with something called quantitative easing, and Japan were the first people to bring that in when they
When did this? The 1990s?
Late 90s, okay. as we went into 2000. So Japan was the first country after the Japan stock market crash of 1990s. You remember the
it was
peak?
89,
Exactly. 89,
around the 89.
So Japan went into zero interest rate policy. So it was the first country to go into.
Were they the first also to go to the negative?
Exactly. Which they still are. And so when you go into zero policy, it means even in a recession you can't do anything, because how will you hike rates when you're in a recession? You can't. You can't lower from zero. So how do you bring back the markets when
look for another tool?
Exactly. So they looked for another tool. That's quantitative easing. So quantitative easing now means printing of money on debt by the Federal Reserve, by the central banks, to just pump that money in and try to see how it will affect the markets. And normally the economies come back up. So they don't do it. I think it's also important for us to explain that the mandate of the Fed is not to control the markets. Like the Feds are not, the markets will affect the Feds, but that's not their job. Their job is to control what is happening in the economy.
Basically, the economically, the Fed has two main roles. It's called the dual mandate.
Exactly.
It's to price stability.
And employment.
Dual mandate.
Dual
mandate. Price stability and unemployment.
Exactly.
Yeah.
So
if you look at that, it has nothing to do directly with markets.
Nothing. Price stability.
Okay.
So by employment, it means everyone has a job. That's the job of the Fed, to ensure that. And the second objective is price stability. Yeah. So they need to control inflation, and they need to ensure we don't go to deflation or inflation. So they just keep controlling.
And I remember Philip Powell was mainly being asked those things.
Exactly.
I think, okay.
So if you go back to, so they tried to now look for a lever which can work in doing these two things. And one of them was pumping money to the economy. So when you pump money, you give money to the companies, you bail out companies which are struggling. You do some of these things. It's called quantitative easing. You have bond buying. So bond buying is like buying securities also. You come back and try to bring in liquidity. It's basically an effort to bring in liquidity to the economy. And when you do that, often it works. It brings back the economy. But after the economy is back, you need again to remove some money from the economy to avoid things like inflation. So inflation normally comes up when there's too much money chasing very few goods. If you have 1,000, he has 1,000, I have 1,000, I have 1,000. Money, one of the features of money is it's scarce. If money is not scarce, it doesn't have value. So for them to control the economy, for the economy to work well, they also need to make money scarce. It needs to be hard for you to get money. But they can't do that without creating periods where it's easy to get money and periods where it's hard to get money. And that's when they pumping and then there's tapering. So tapering means now stopping those bond buying programs, stopping now bringing in liquidity to the market or to the economy, and taking back that liquidity now into their own balance sheets. So the Feds normally have a balance sheet, and the balance sheet now is also controlled by asset liabilities. And so they'll try to bring back money, increase liabilities, and they'll try to cut back money and cut back the liabilities.
And that's what now the Feds are doing.
That's now what the Feds are doing. But there are risks contained in some of these things, because like Lawi was saying, the primary job of the Fed is price stability and employment. Now, right now, they've started tapering.
Actually, right now, they've moved into another sector that is not their job.
Which one?
Financial market stability.
Exactly. There's also markets now becoming dangerous.
Right now, they just want e-markets to go to stable kwanza. It's a crash kwanza.
Exactly. Because also if markets crash, markets crashing is an indication of what's coming to the economy.
Yeah. So as you are saying, markets are ahead of reality.
Always. And if you look at even how markets performed, one of the reasons why, like Larry is saying, someone like me was left out in a very big move of the bull market was I expected to wait for the economy to come back a bit for markets to price that move. But markets don't care. The economy is not working. Okay, there's a lot of money in the economy. That's all we know. And markets will just keep on moving higher and higher and higher. So they'll price that moving and just keep on zigging up. You get? So if you look at what now the Feds are trying to do, is they're trying to at least control that too much money. And the thing that is bringing them risk is not actually just asset prices, it's inflation. Because inflation sitting at 5% for a very, very long time is dangerous. Initially, they'd say it's transitory. But it's transitory, they always mean we've just gone into a recession, we've pumped in a lot of money, we're still trying to come back up. And so there's expected for a period of 6, 3, 4, maybe a year we'll have inflation. But when that inflation keeps persisting, it becomes dangerous. Because now that means this is an inflationary environment. That is not good for the economy.
And right now we're at all-time 30 years highs in terms of inflation.
Exactly.
Way higher, not way higher, but just a bit slightly higher than 2008 crash.
Exactly. Yeah. If you look at some of those things and then compare how much money was pumped in 2008 to how much money has been pumped now into the economy.
Yeah.
It's a lot.
It's too much.
Exactly. It's too much. So even if you look at markets, what some of the markets are doing, it's very easy for you to understand that some of these markets are really, really trending strongly to the upside due to the too much money that is already in the market. But in this environment, the party will soon end. Because there are two things which I think it's now important to think about. One is inflation. The other one is the rates. The other one is what the impact of these two things will have on the economy, and then from the economy to the asset prices. So for example, in their effort to try and control inflation, they could be forced to hike rates. They could be forced. They don't have an option. They are forced to hike rates.
Their initial trajectory of the dot plot was to be
in 2023, 2024.
And now?
Now we're in 2021, 2022.
So they're expecting around 2022.
Yeah,
so
we'll
they're
have a
pushing
rate
it
hike.
a bit behind.
So if we start having a rate hike, there's a very, very high chance you're bringing in a rate hike in an environment where there's no full employment, the economy is not fully recovered. So what's likely to happen? You're likely to send the economy back into a recession. That's one of the major risks that they have. What will they do in such a situation?
Basically,
start playing with the levers
that
again.
Easy money has been taken out. Now,
exactly.
At the same quote comes, we will see now who has been swimming naked.
Now we'll see. Exactly. Because there are very many people in the markets currently, especially if you go back just into the financial markets. There are very many people. Because was it you that was telling, I'm sure in America right now there's someone living his best life, assuming he's a guru in the stock market, just because he keeps on buying and
crypto
buying and buying. Exactly. He assumes it will go up forever.
Crypto.
He doesn't understand there are tough markets, there are sideways markets.
They don't understand how interest rates can affect all markets.
So alilearn 2 strategies. Akaona nikibaingi inaenda, nikibai inaenda. So he has just been buying. If you look at a company like Tesla, I don't think there's any rational investor who's been buying Tesla.
We're at what? 1,200. That means
55% in 1 month.
55% move higher. And this is a company which is among the top 5
$1 trillion company
in the world.
In the world. So now it's at $336 billion Elon Musk. He just added 10 billion yesterday, and this whole year he has added 167 billion. And I was telling Ken, we're discussing with Ken, this guy's added 167 billion in 1 year. This the richest man who has been the richest man for 30 years has never reached that price.
Bill Gates
knows at 137.
Now amekuwa rich for over 30 years. Amekuwa top 4.
This guy in 1 year alone, 167 billion. And you're telling me markets are rational at the moment?
No, markets are not rational. But you know, markets now can remain irrational longer than you can remain solvent. So you really have to try as much as possible to avoid trying to say it will go down at this point.
Of course, can't catch a top. And I keep saying you can't catch a falling knife, and don't try to stop a charging bull.
Exactly.
Najongele game, don't play that game.
So if you look at markets right now, I think it's also important for us now to come back into like the end markets are hot everywhere. Even in Kenya now, everyone wants to learn how to trade. It's now famous. Like, hey, there's an opportunity in the crypto markets. People even know Bitcoin more than cryptos. Like they don't even understand the blockchain technology built on blockchain on Bitcoin. Like the technology Bitcoin is built on blockchain technology. So it's a very, very
just
risky.
Bitcoin.
It's a very, very risky environment, but in that risk there's some opportunity.
Before we move on, the same way I was telling you guys how Microsoft moved from it took 45 years for Microsoft to reach $1 trillion. And only under 1 year
we're now at $2 trillion.
$2 trillion.
Exponential.
So, like ile effort ya 45 years unataka kuniambia can be equated to kwani wa jamaa wanawaka how many hours a day?
Increase.
It's not rational. It's not rational at any point.
And now Tesla is the second fastest company to reach $1 trillion behind Facebook.
Tesla
is also at $1 trillion.
$1 trillion.